Good afternoon, and thanks for joining us today for our first session in our post-election webinar series. My name is David Blaine. I'm a partner at McConnelly and Asbury and director of our entrepreneurial services group. And we are so disappointed that we couldn't come together for our annual Collaborate conference this year. We are excited to close the year out, though, although with this webinar series, and discuss how the presidential election may impact you and your business for 2021. On the screen now, you can see a little bit about our firm. For those that are not familiar with McConnelly and Asbury, we are a team of CPAs and business advisors serving clients from our offices in Camp Hill, Lancaster, and Bloomsburg. We provide a variety of services to industries, including the ones you see on the screen. We encourage you to visit our website to learn more, and don't hesitate to get in touch with our service or industry experts to explore how we can partner together to best serve you and your organization. Before I turn things over to our presenters, I want to mention that if you have any questions for the speakers during the webinar, please submit them through the built-in question function in the webinar control panel, and we'll do our best at the end to try to address these questions throughout the webinar. There will also be 3 polling questions, so everybody listen up, because I know there's a lot of CPAs that need the CPE credits. There's going to be 3 polling questions. You need to make sure you answer all 3 polling questions. We will be sure to prompt you when the polling questions are coming up. But I can just tell you now, it will be slides 10, 24, and 35. So be prepared around those times, okay? So today, we're excited to have with us our first presentation, and that's River Wealth Advisors. They're going to be joining us today for this first presentation to talk a little bit about what's happening in the markets and what we might be expecting in the markets going forward. So with that being said, let me introduce you to our two presenters today. The first presenter, Ed O'Gorman. Ed, I've known you for a really long time, I think. So I'm excited to hear you talk today, Ed. And also with Ed is Eric Wiegand. Let me tell you a little bit about Ed, though. Ed, along with Bob Kaplan, formed River Wealth Advisors in 2015. He began his career in the banking industry, managing large institutional fixed income portfolios. In addition to more than a decade of service in banking and institutional investment management, he also has extensive experience managing personal, trust, and private equity portfolios. His experience as a diverse financial management positions helps clients navigate economic downturns and market fluctuations. Welcome, Ed O'Gorman. And along with Ed is Eric Wiegand. Eric begins over a decade of financial planning and relationship management experience to the firm, with experience both at a leading financial brokerage as well as several regional banks. With a focus on financial planning, Eric helps clients identify their financial objectives and needs, and then builds a personalized plan that align with their financial goals. In his market leadership role, Eric is responsible for serving Lehigh Valley clients with excellence and expanding the presence throughout the region. And you know what, Eric? I love the bow tie. You look good in that picture. So I'm going to turn it over to these 2 guys, and we'll let them get on with their presentation. Turn it over to you guys.
Thank you, David. This is Ed, and thanks everyone for participating in the webinar today. We appreciate your interest in hearing what we have to say. Just to kind of go over our outline for the day, for the call, some topics we're going to cover. We're going to talk a little bit about election results and implications there for financial markets. Also, recent regulatory changes and their implications not only for financial markets but for individuals and businesses as it pertains primarily to retirement plans. Eric is going to walk through those topics for us. Then I'm going to talk a little bit about the markets and the economy and sort of, where we see things today and where we see things going from here over the next year or so. We'll close with some final words and then take some time for questions. So I am going to turn it over to Eric, and he is going to cover election and regulatory matters. Thank you.
Thank you so much, Ed. Thank you so much, David. So happy to be a part of this awesome webinar series. So for my portion of this, we're going to attempt to frame some of the more numbers-driven approach to investments that Ed's going to go over by really taking a look at the election results, some potential legislative topics that might come as a result of this election, and then wrap up on my portion of it, really looking at those pieces of legislation that have already been enacted that will continue to impact how we're going to want to approach and manage portfolios. So with the election results, let's look at where we stand today. For the office of the presidency, Vice President Biden has been declared the winner, so he's our president-elect. And as he builds out his cabinet, we're starting to see names emerge that tend to be more moderate in the Democratic sphere. And this was something that was watched very closely, particularly given some of the rhetoric prior to the election. You know, on the financial side, we're seeing a name like Janet Yellen for the nomination for Treasury Secretary. That's a name that particularly financial markets know very well and we've had experience with. And so that, particularly from a financial standpoint, is carried over into other portions of the cabinet where there are some names that have experience in Washington, particularly during the Obama administration, and have been met with again, that theme, that feeling of moderation. For the House of Representatives, the Democrats still retain majority control. However, the Republicans, the minority, has picked up 10 seats, which does have wide-ranging implications, right? We're looking at some opportunities from a legislative standpoint that, you know, really could be designed in different ways. And the fact that Republicans were able to pick up 10 seats does call into question some of the existing majority leadership inside of the House of Representatives. And so that's going to have some implications as we look further. The Senate continues to be the most exciting part of this election. It is not spoken for by any stretch of the imagination, but at this point, 98 seats have been claimed, 50 have been reclaimed by the Republicans, 46 have been claimed by Democrats, but there are 2 independent seats that have been claimed that tend to caucus with the Democrats, but do not specifically call themselves Democrats. So from that standpoint, all eyes are on the Senate. And with those 2 unclaimed seats, we have 1 state to look toward. So when we think about what's going to happen in the Senate, we're looking to Georgia. And in Georgia, we have 2 runoff elections that are scheduled for the first week of January. And these elections can be incredibly tough to predict. But I don't want to steal the thunder of next week's presenter with James Lee coming in to tell us about polling, which I personally really look forward to. But let's talk about the implications of what could happen in Georgia. First off, if the Democrats happen to win both of these runoff races, there's a 50-50 tie in the Senate, which again has a really interesting implication because that would mean that the vice president would have the tie-breaking vote. In this case, would be the vice president-elect, Kamala Harris. This would give the Democrats a majority in any scenario where they needed to have 51 votes. Now, that being said, the chances of the Democrats winning both seats at this point is something that could definitely happen. But even if the Republicans win at least one of those races, they will continue to have the majority in the Senate. So let's just pause there and think about the implications of a split Congress where the Democrats would have the House and the Republicans would have the Senate. If that were to occur, we would have a scenario where it could be very, very difficult to see legislation pushed through that would be unpopular on the Republican side or on the Democratic side. And so when we think about Georgia and the things that could occur, those implications are the things that we're kind of looking towards as that base case. And so let's think about what is expected on the legislative agenda for 2021 in the event that the Republicans were to win at least one of those seats in the Senate. and we would see a split Congress. One implication would be we'd have to have compromises for things that could be passed. The expectation and the rhetoric and all of the things that we believe financial markets have, at least in some way, shape, or form, priced in, would first be that of economic stimulus. We saw earlier this year twice Congress attempt to come together with the White House and pass another round of COVID-19 related stimulus. In the summertime, it was a failure, as well as in September, just before the election, it was a failure. In the last 48 hours, we've seen a flurry of activity that would seem to suggest there's a chance to see at least some moderate, at least relative to what happened in March with the CARES Act, some moderate economic stimulus passed. But even then, there's still a lot of pieces in play, and there's still a coin flip odds on if we'll see that this year. So again, our focus is what would happen in 2021. Even with a split Congress, there is going to continue to be pressure to see economic stimulus passed. And so this is a big piece of recognizing that even if the current Congress were to pass some economic stimulus, the expectation for 2021 would still very much so be there. The next issue that we'd expect to see some compromise on would be infrastructure spending. This is a topic that's received broad support on both sides of the political aisle, and something that was very positively received in the re-election cycle that we saw here in 2020. It was something that a lot of elections were won on, and a lot of promises were made. And so we will look for that. This last one is something that I personally, as a planner, am very excited about. Over the last three and a half years, we've seen some really exciting changes be proposed and enacted in the world of retirement savings. And we're going to talk about the Secure Act here in a couple seconds, but what I want to focus on here for 2021 is the idea of the Secure Act being extended. And so this is being dubbed Secure Act 2.0. And again, it's very, very early in its legislative cycle, but both the majority leader and the minority leader of the House Ways and Means Committee came together and drafted a new act that will take some of the more popular thought processes of the Secure Act and take them a step further. And again, when I say it's early in its legislative life, I will mention that the popular portions of the Secure Act are fairly expensive to the U.S. balance sheet, to the government's balance sheet, and this newest extension, or this Secure Act 2.0, at this point does not have the provisions that would potentially pay for some of these extensions. And so I really want to preface that before I mention what this Secure Act 2.0 may possibly offer us as individual retirement savers, and more importantly, as leaders of business, and how we structure and how we implement our qualified retirement plans to our employees. But the early indicators for Secure Act 2.0 would have some big changes to it. First of all, it would eliminate required minimum distributions for any pool of pre-tax qualified assets, so think 401k or traditional IRA, that had balances under $100,000. Secondly, it would increase the age that would force the beginning of required minimum distributions from 72, where it currently sits, to 75. Thirdly, it would force any new qualified retirement plans to auto-enroll all of their participants. And this would be an extension of the Secure Act to also include 403B plans, 401As, 457s, some of those that were unfortunately left out of the Secure Act. Lastly, it would have a very impressive, potentially impressive match, that if you had younger employees who maybe didn't have the capacity to save into their qualified retirement plan because they were paying for student loans, The Secure Act 2.0 in its current form recommends the opportunity for companies to match the expenses that the employee is putting towards student loans inside of the 401k plan, which again could be very, very powerful from a design aspect. So we'll have to see how the Secure Act 2.0 plays out and really where some of those pay for ideas come from. Because again, anytime we're talking about a revenue-driven bill, if it is going to add to the deficit, there is a strong desire to see some portions of that bill pay for itself. And so I'll have to watch that really carefully. Outside of these potential compromises, there is a lot of concern around tax increases. Again, if the Republicans even win one seat in the Senate, the opportunity for major tax increases to occur are very, very, very unlikely. Even if the Democrats were to win both seats, it would increase the likelihood of major tax increases across the board. But really the two main tax increases that had broader support during this last election cycle were a scale back of the corporate tax code that the Act of 17 was so powerful in bringing down to 21%. Expectations were, even if there was a chance for it to be repealed, it'd only go to 28 or so. And then any other tax increases on the personal side would really be reserved for folks who had a very high income, something to the tune of over $400,000 of income, of household income. And so those are things that, again, if the Republicans even pick up one seat, we believe to be very, very unlikely. But even if the Democrats pick up both seats, will still be a very difficult execution for the administration. Lastly, when we think about 2021, we look towards the expectation of there being a lot of executive orders, particularly if there's a split Congress. Again, if the Republicans are able to retain the majority in the Senate and the Democrats have the House, we would expect the executive branch to utilize their ability to regulate and to set policy to really set the tone of a lot of some of the agenda items that the administration has. And so that's an expectation that we can look forward to for 2021.
Okay, so as I told everybody, we're at polling question number 1, and polling question number 1 will give everybody about a minute here. But who do you believe will control the U.S. Senate after the January 5th runoff? Give everybody a minute or so to answer those questions, but see what everybody thinks will be the runoff winners here in Congress. What do you guys think? Ed and Eric, what do you think? I mean, if you were a betting man, who would you go with? Do you think the Republicans can win one of those two seats? I mean, I think the Republicans are actually win both seats, but we'll have to wait and see.
Yeah, I think if you go by the numbers, you would expect them to at least take one of those seats, based on what the projections look like now.
But as you said, there's going to be a lot of money rolled into this thing, so we'll have to see what happens. I mean, the amount of spending in this is going to be crazy. So we got 10 seconds left to answer the poll. 5, 4, 3, 2, and 1. All right, let's see what the results were. 82% think the Republicans will keep control of the Senate. Okay. All righty. All right, I'm going to turn it back over to you guys. Let you keep going on.
Perfect. So we covered where we stand for the election and some things to look forward to in 2021. We just wanted to really quickly touch on some things that were enacted in the last 18 months that are already signed into law that, again, are very important pieces of both the individual approach to portfolio management and, again, how we would work with business owners to make sure that they're properly positioned as well. And so there were two major acts that came, one at the end of 2019 and then two in March of 2020. And I'll start with the CARES Act. So the CARES Act is the Coronavirus Relief, the Stimulus Act. This had wide-ranging effects into personal retirement planning. First of all, it waived all required minimum distributions. It even gave individuals the ability to redeposit any withdrawals, any distributions that they'd taken from their retirement accounts up until the middle of the summer, which was very, very powerful for some clients who, again, had concerns early, took the cash, thought about it, and again, were given the opportunity to put it back. It also had wide-ranging effects with withdrawal penalties based on age groups with retirement accounts. So waive the excise tax, the penalty of 10% for early withdrawal, up to $100,000 for this year, which was great. It also increased the amount that could be taken as a loan from a qualified retirement plan from $50,000 to $100,000, and that's a number that has not been messed with forever. I don't think, a very, very, very long time. And lastly, and possibly most powerfully, the CARES Act recognized how certain philanthropic organizations might be leaned on more than ever during this pandemic, and that those organizations might have a really difficult time receiving donations. And so the CARES Act took a really exemplary, a very, very far step in easing the restrictions on charitable giving deductions. For example, and again, if this is something that you haven't had a conversation on yet, please, please, please have the conversation before the end of the year. But under the CARES Act, you are actually able to give away cash donations to qualified charitable organizations and receive a 100% deduction against AGI. That is a big jump from where those numbers stand before the CARES Act. And so from a particularly personal tax planning perspective, it's something that's really powerful. And the numbers for corporate giving are also very, very high. I believe those were doubled as well. So the CARES Act continues to be a very strong piece of legislation. Again, we're looking for the stimulus for 2021. There hasn't been any conversation about this particular, or the portions of this act being extended, but there are rumblings, there are rumors that particularly the retirement planning portions and the charitable giving portions of the CARES Act could easily be extended. The one we really want to focus on, though, is the Secure Act. This is something that, again, from my perspective, is really exciting. A lot of personal retirement, a lot of the laws and statutes that propel the design of personal retirement planning haven't changed for a long, long time, other than some, quite meaningless cost of living adjustments. The Secure Act at the end of last year made some very large moves to really change the potential complexion of how we design retirement planning for clients. In this case, like I mentioned with the Secure Act 2.0, there's always a little bit of a give and a take, right? So in the Secure Act, we have a give in that the required minimum distribution age went from 70.5 to 72, which is just a year and a half, but it's still meaningful. But what it took away, though, the take, was that beneficiaries of any IRA that are non-spousal, right? So any non-spousal beneficiary has to withdraw the assets within 10 years following the account owner's passing. And that has a gigantic implication, particularly to those families that are in a position to leave IRA assets to kids. The expectation prior to the Secure Act was that there was a lifetime stretch, meaning the beneficiary of those IRA assets were able to stretch their distributions over their lifetime. Now that went from, say, a child's lifetime, 50, 60 years of distributions, to a 10-year time frame, that gives the implication that we could see a higher percentage of taxes come out of those assets. So this is something that we watch very carefully. And again, as we talk about investment planning, these are the types of things that we coordinate to make sure that we're seeing more than just the numbers. That being said, for the numbers, I'd like to hand it back over to Ed, where he can run us through some of the the more important parts of our economy and markets.
Thank you, Eric. And my goal is to give you guys some highlights on things that we're looking at in the market, areas that we like to focus on, and things I think that are just generally interesting. To get things started, really, there's been almost some disbelief on what, with respect to what's going on in financial markets, particularly equity markets, since the election. You can really note the momentum behind stocks, really globally stocks, particularly though growth stocks in the United States have performed exceptionally well. And the question comes up often, what's behind this? We're in the middle of a pandemic. We're certainly in some portion or some part of a recession. We don't know, how long this recession is going to last. But what is the market looking at that is driving this performance? And so just the themes, I think, right now are numerous, but we try to highlight a few that we think are important. And certainly, near the top of that list is that we now have multiple vaccines that have passed muster in terms of efficiency. So that's a major boost for the market. And again, the market is looking down the road, and that success with vaccine development has really boosted the expectation for mass vaccination early next year, first half. The market was, I think, at some level relieved that there was a decision in the election. And there was a lot of concern leading up to the election that the winner wasn't going to be known with certainty, and that ultimately that could lead into a long period of really lack of direction, and we're in a situation where certainly we need Washington to be firing on all cylinders as best possible. So that there wasn't likelihood of protracted discussion around the winner was a relief to the market. There's also certainly a strong belief that the Fed is going to continue to be there to keep rates low and provide liquidity. Low interest rates are critically important to supporting asset prices. So, ultimately, as we talk about getting into the numbers, how things are valued, as a financial analyst looking at future cash flow, what's that worth? One of the key inputs is, well, what's the discount rate? And so, when you've got the Fed holding rates very low on the short end, providing liquidity on longer term bonds, it really is supportive of asset price levels, whether they're stocks, real estate, et cetera. I think largely the market remains hopeful that stimulus is on the way. I'd say hopeful that they'll get something done before the end of the year, potentially more likely early next year. And then as Eric has discussed, the expectation that regulatory changes are going to be measured. The market ahead of the election, on the back of really the polling data, was looking at the potential for a blue wave. And again, as Eric has sort of covered, some of those changes that would have come along now seem a bit more distant with respect to major tax overhaul. Although the regulatory piece, as we've said, is still on the table. So that's really what we see kind of driving the market right now. And, I think realistically, given the uncertainty, the period of time we're in history, we should expect a bumpy ride. We should expect this, particularly as we go into this winter when there could be, considerably more lockdowns and economic disruption around coronavirus. I I think we really need to look at what's going on in the markets and look for opportunities to reallocate within our portfolios. Just a couple more, I mean, with a lot more numbers, but just to sort of talk about some high-level numbers. What has the market provided? And so we're looking sort of over 1, 5, and 10 years. Really, since the financial crisis in the long term, the U.S. stock market has really led the way. You know, international and emerging markets have lagged considerably in the long term. This is largely a result of sort of how various economies pulled themselves out of the financial crisis. Certainly, we had a very aggressive, stimulative policy stance and aggressively pushed liquidity and used new tools that hadn't been used before with the Fed and the Treasury, out buying securities in the open market. You know, back in 2008, 2009, those were all novel concepts. They're being employed again this time around. And we'll talk a little bit about the implications of that in terms of federal debt. But it was certainly successful in providing good equity market returns relative to the rest of the world. I think, you know, this year, and we'll talk a little bit more about this year, but the last 12 months, you know, that continues to be the story, although we've seen a pretty nice bump in emerging market performance really through this year relative to U.S. market. One of the things that certainly should jump out is when you look at the returns on bonds, particularly the short-term returns on bonds. You know, when you have the Fed in the marketplace buying bonds, essentially providing a put on fixed income yields, it drives performance. Again, looking down further in the page, the expectation should be more in line with long-term returns. I think what we see this year are pretty outsized, unsustainable returns in fixed income and bonds. But you know, for the U.S. bond market to provide over 7.25% relative to that long-term average of 371, those are sort of long-term numbers that stand out. In terms of sort of our domestic observations, the big story here is how much growth has dominated our market, and sort of some rates of returns were ranked year to date, and you can see that, you know, really large growth has led the way. And there we're talking about, you know, the notable FANG stocks, the Facebooks, Amazons, Apples, Netflix, Google. Just to kind of put that in perspective, and using the NASDAQ in the lower right corner as a proxy, you know, when you've got the broader large cap market has done about 16% rate of return year to date versus NASDAQ that's up almost 37%. So as we emerged from the pandemic, there was a clear theme. The market was being dragged higher by a fairly small group of very big tech companies that were actually positioned quite well for what our economy was confronted by. Now, as we've sort of approached election cycle and through the election, what we've started to see is some rotation into other cyclical areas of the market. And what I mean by cyclical is those areas of the market that tend to move a little bit more in lockstep with GDP and broader economic performance. I'll talk a little bit more about that. But again, the big theme is just growth has been critically important to portfolios. Technology has been a big piece of that. And the disconnect between value and growth has really been persistent for several years now. Value has really significantly lagged growth. So those tried and true dividend payers have been somewhat left behind in terms of performance. Again, that's starting to change a bit as we're starting to see some sector rotation. The phenomenon is consistent across both large and small companies. But again, I think at the end of, or leading into the end of November, we've really seen small caps start to pick up again. To get into some of the, what I talk about, this rotation into cyclical names, and I think is what we have here is really a breakdown of market performance across industry group sectors. You can really see as you focus on the past 13 weeks versus year to date where this rotation is occurring. So again, year to date financials are down 8.1%, but in the past 13 weeks, a little over 12.5%. Industrials 13%. Materials 12%. Again, over this past 13-week period, and largely that's in November after the election. And relative to, we have year to date, we've had IT, information technology, return, almost 33%. It's been pretty much flat for the past month, 3 months. So really that rotation, the other piece of technology, technology is buried inside communication services and consumer discretionary sectors. That's where discretionary is where Amazon lives. Communication services is where Google and Netflix and Facebook lives now. So again, you can see those two sectors, high double-digit returns with discretionary at 29%, services at 19%, falling back to 3% as we've been able to observe this rotation. One other number that probably jumps out there is just how poorly the energy sector as a whole has performed this year. Certainly, there's been a nice bounce and oil prices have recovered over the past few weeks, but down a little over 36%. And as we talk about regulatory changes and sort of tactical adjustments inside portfolios around those potential regulatory changes, clean energy, the clean energy component of this sector is actually up almost 70%. So that's a lot of people getting ahead of potential regulatory changes. But again, where you are within these sectors is very important because you will have certainly winners and losers across the board. Pardon me. To talk a little bit about bonds. Really staggeringly low interest rates that we have, a market right now where short-term rates are essentially anchored by the Fed. The Fed is saying they're not going anywhere for quite some time, a number of years. Long-term rates also to some degree being anchored by Fed buying activity. But we have, a very narrow spread between short and long-term rates. We would refer to as a flat yield curve. We expect that to persist in terms of, really historical averages. It's going to be very flat. But we are starting to see long-term rates start to pick up a little bit. The risk, I think, ultimately, we'll talk a little bit more about this, is that, we get the economy back on track and have essentially a spike in demand that pushes some price inflation, that we might see those longer-term rates of interest really jump higher. That is, again, I'll cover that a little bit more in a minute, but that's a real concern. But you can see that, since June, June through December, we've had a bit of an uptick in the long-term end of the yield curve from 10 to 30 years. The other piece of the fixed income market, away from interest rates, is really looking at credit. And so, right now we're in a really unusual position, and this bottom left graph sort of shows this is the credit spread or the additional income you receive for buying junk rated bonds, in essence. And you can see that, typically at times of recession, you go back to 2008, this spread can really jump way out. So, double digit spread relative to high quality bonds is not unusual in times of great financial stress. But as you can see right now, we're near all-time lows. So there really is very little benefit to taking material credit risk right now, given that spreads are nearly priced to perfection. And again, those spreads are applied to this treasury curve, which is nearing all-time lows. So bonds are an important component of a portfolio, from structuring cash flow, managing overall risk. But again, right now, this is not going to be a place where you can expect to get significant rates of return until we start to see the economy turn the corner a bit, and we can get some better yielding bonds. And again, just point of reference, the 10-year treasury is at 0.875%. It's less than 1% for 10 years. The 30-year is roughly 1.5%. And if you go into low investment grade corporates, so single A to triple B, you're still out 5 years or so. You're looking at 2.25%. It's a very challenging yield environment right now. But best for in our opinion, for folks to remember why bonds are in the portfolio, what they're there to do, the purpose and the construction of the portfolio, and unfortunately live through this period of low yields. So from here, I just want to touch on a few things that I think are interesting from an economic perspective or economic data. And certainly, top of the list right now is the labor market. We've got a partially shut down economy. You can look back over time to see really just how dramatic the reaction to COVID has been in this cycle, and that the labor force is essentially shrunk now by about 4 million people. Participation rate is down about 2%. Unemployment rate spiked out at double digits. Overall, it's come back down in from where it was, but coming from what was essentially all-time low unemployment rates, almost unemployment rates that look unsustainably low, given that we really didn't have any inflation going into the pandemic either. So we've had some recovery there, but still quite a ways to go. And as you look at the kind of the high frequency labor market statistics, the one that we see every week, right, the initial jobless claims numbers, which come out every Thursday. And if you look at it, I like to use pictures to sort of illustrate, but if you look at that graph on the left, you think, wow, in the last 12 months, yeah, it's spiked up, but it's kind of normalized. It's come back down. When you kind of put that in the context of long-term, you can see that we still have a major problem with weekly claims coming in the neighborhood of 1 million a week. It's down in the 800,000 to 900,000 range right now. That's about as bad as it got in 2008, 2009. So we're still not back to sort of the bottom of the last cycle. So we've got a long way to go. I think we should expect some persistent unemployment even as we get back to what we hope to be a more normal environment with the vaccination. Just a couple other quick notable economic numbers. I like to look at consumer sentiment. The consumer is a huge part of our economy, nearly 2/3 of our economy. And you can see on the left that, yes, sentiment is down. So how people feel about economic conditions is down sharply. But again, it's somewhat above what we've seen in past recessions. A lot of that has to do with stimulus and the ability of monetary and fiscal spending to help carry us through. Certainly, we think more of that is needed. Again, retail sales continues to plug away. One of the big bright spots in the economy is the housing market. Just a couple slides on this. Our rate of home ownership, the blue line in the top left graph here, is starting to tick up, but we're nowhere near the inflated levels we saw in 2006, 2007. Very reasonable home ownership rates, and you can see the prices just sort of continue to rise, and that is, there's a tremendous wealth effect associated with rising housing prices, and that folks can access that wealth fairly easy. So from that perspective, things are looking very good. You can see, again, on the supply side, the month's supply of homes out there for sale is about as low as it's been. So we really like this market as an investment opportunity. Again, it's supported not only by good fundamentals from the supply side, but also we've got record low 30-year fixed rate mortgage rates. So affordability is about as good as it gets from an interest rate perspective. Some of the concerning things that I brought up earlier, getting into kind of the government debt situation, looking at across consumer and government debt. Household debt for the consumer is really looking good. It largely corrected itself after the financial crisis. The levels we see now are consistent with the early 90s, but it's the federal debt that you can see we've had some major bumps. Not only the most recent spike in federal borrowing, but the borrowing associated with the financial crisis. Significant build in federal debt. We talk a little bit about taxes. Someone is going to have to pay for this eventually. The good thing, I think, right now is that the government continues to be able to borrow at these fairly low interest rates. So they're able to carry this debt load. I should say we are able to carry this debt load. The other thing I think is interesting to point out is this money supply. So essentially, these are checking and savings accounts. They could be corporate or individual, but the amount of money supply, this boost, right, that was partly stimulus related, partly folks just saving more if they could through a pandemic. There's a lot of money on the sideline. I think there really is significant pent-up demand, and that really gets us to kind of the last of the economic slides, which is price indices. Again, if you look at it in the short term, you see some unusual volatility during this pandemic period, where it looks like things are starting to jump out of line. But when you take that and put it into the context of longer term, we haven't seen real inflation for call it 30 to 40 years. But you look at that graph, real inflation was in the late 70s, early 80s. That's ultimately, I think, what we need to be afraid of if there's a real snapback in demand and economic activity, with potentially the supply side lagging behind.
Okay. Let's move on to polling question number 2 and kind of keep things rolling here. So I'm going to keep this quick. We're going to give everybody about 30 seconds to answer this poll, but are you planning to make any big purchases or investments in 2021? Yes, not sure, or no. Give everybody about 30 seconds and answer these polling questions. Keep this thing moving. Okay, 10 seconds for everybody. 5, 4, 3, 2, and 1. All right, let's take a look at the results. What we have here. It's pretty much even. Yes, 38, not sure, 35, and 27% said no. So if that's any indication for you guys, Ed and Eric, where the economy is at for 2021, at least that gives you a little bit of an idea. Turn it back over to you guys.
Thanks, David. So I just kind of want to transition now into sort of looking forward. Eric referred to our base case, the road ahead, and really it is, our base case is that this recovery continues into 21, and that, we do believe we'll have this vaccination roll out. We think this rotation into cyclical sectors continues. Technology is going to remain a key driver of performance, but the likelihood, if you follow the logic of vaccine being distributed, of more economic activity in those cyclical areas, it just follows that the rotation should continue. We don't anticipate a jump in interest rates. Again, we need a gradual economic recovery to prevent, rapid inflation. I think that's everyone's goal. And then finally, there's going to be some regulatory changes. There could be some clear winners and losers. We mentioned things like, really fossil fuels, potentially banks and parts of healthcare, potentially having heavier regulatory burdens, while other parts of healthcare and utilities and IT, potentially come out with some benefits. From an investment management perspective, we think investors need to be thinking about here going into the next couple of months, next year, is expect volatility. Volatility has calmed significantly from where it was, but I think anticipate its return and take advantage of opportunities it creates to rebalance. Our focus on individual investors' accounts is really understanding what the right risk budget is for you as an investor, and using that to really ground your investment decisions, to provide discipline around that. And the rebalancing process is one of the ways to do that. Within your equity portfolio, I think certainly there will be some tactical opportunities around regulatory developments and things like that. But ultimately, staying anchored to what works. Change should be gradual. And then finally, on fixed income portfolios, what do you do in this interest rate environment? We think, target shorter duration, keep quality fairly high, and hopefully look to move your duration, your term structure out a bit as we see rates. We anticipate rates gradually rising over the next 12 to 24 months. And finally, you hear a lot about going through election cycles. What does it mean for the market? And just a couple slides on that. Ultimately, if you can stay long term, what this is telling us is just be a long-term investor. It doesn't. That's the critical part. Stay in the market. Who's in the White House typically doesn't have that much of a deterministic factor on what the performance is. It's sort of what did they oftentimes inherit in terms of economic situations. So as you can see, generally, markets go up unless there's a depression or a once-in-a-lifetime financial crisis. Markets generally reward you for staying in them. And again, just one more sort of slide on that, on the discipline side of things, which is you look at the growth of a dollar invested in world markets. A lot has happened. There have been a lot of things to worry investors, but the investor has been able to look past that and stay focused on long term. Again, there's the prize. And finally, reacting is potentially very costly. So I like this chart. It just talks about, what if you missed the one best day? Your return went from 9.25 to 9.29 to 8.87. Your wealth dropped, right, by $2,000 or $2,500. You missed the best 5 days, you're down to $775. You missed best 25 days, your return is just a little better than owning treasuries. So again, understanding the right amount of risk, staying invested, and managing to that allocation is, we think, critically important. Just one last quick slide here. We felt we'd be remiss if we didn't bring up kind of the year-end housekeeping items. Again, end of the year, rebalancing to target allocations. Thinking about tax items, so do you have you accumulated capital gains or losses, or those kind of things that you want to work on offsetting? Have you taken full advantage of opportunities with respect to charitable contributions? Have you taken a look at your IRA Roth contribution opportunities or conversion opportunities? Maximize your employer plan contributions for the year, and then certainly a review of the state plan changes, a good annual review. Check in on beneficiaries, make sure that things are set up as intended. So with that,
all right,
I'll turn it back over to you, David. Thank you.
Yeah, sure. So final polling question. Make sure you answer this if you want to get all your CPE credits for today's 1 hour webinar. We're running short on time here. We got about 3 minutes left. Let's get to this polling question. At the beginning of the pandemic, what did you do with your investment portfolio? Did you panic and sell it off, rebalance your portfolio? Did you do nothing, invest more in the market, or did you do something different than what was just listed there? So we'll give everybody about 30 seconds or so to answer this question quickly. Obviously, Ed and Eric are hoping that everybody said that they stayed in the market and invested more into the market. That would be the right answer. So, but anyways, let's give everybody got about 8 seconds. 7, 6, 5, 4, 3, 2, and 1. All right, let's get to the answers here. Let's see. Okay, nobody says they panicked and sold off. That's good. Rebalanced 17%, did nothing 46, invested more in the market 33, and 4% said they did something different. So, all right, guys. With that being said, we're down to about 2 minutes left in the webinar. Just want to kind of go over a couple quick things. On behalf of McConley and Asbury and River Wealth Advisors, we want to thank you for your participation today on our webinar. A recap of today's presentation will be posted on our website in a few days, and for those who need CPE, the certificates will be sent out within the next 2 weeks. Also, be sure to register for our next 2 sessions in our post-election webinar series. Next week should be an interesting one. We have James Lee with Susquehanna Polling and Research on December 10th, and he's going to discuss the polling process, the data gathered from the polling process, and what some of the exit polls were telling us after the election. And then on the 17th, we have Dean Zerby and Rick Lazio will be joining us from Alliant Group to provide us an outlook from the Hill, year-end taxes, and what we might be expecting in 2021. So again, you can see that's up on the screen here. Please feel free to register for those events. Again, on behalf of McConnelly and Asbury, I want to say thank you again to Ed and Eric. You guys did a great job today. Thank you for your time today. Really appreciate the information and the insight that you brought to the table. Anything else you guys want to add?
Just thank you for inviting us to participate. We appreciate the opportunity to share our thoughts and our relationship with McConnelly and Asbury as partners working together on a lot of clients. Thank you.
Yeah. Hey, Ed and Eric, thank you again. And again, anybody have any financial questions, please feel free to reach out to Ed and Eric over there at River Wealth Advisors. So again, thank you very much. Have a good day.